SVB. It's Silicon Valley Bank, which if you follow our channel here at all, you'll know that we don't really like or use centralized third-party banks. Our entire channel is devoted to teaching you how to be your own banker and practice the infinite banking concept. But alas, millions of folks out there are still using third-party banks and are prone to situations just like this. You've probably seen this in the news, but here's my take as a person who runs a small business and knows a thing or two about banks. So here's what was going down. It all starts with the fractional reserve system, and here's how that's explained. Banks can loan out more money than they actually have on hand. That's right. At the time I'm making this video, a bank can take in $1 but legally loan out $9. Now, loans are assets to banks. They have to loan money in order to make any money at all. Think about it for a moment. You've got a bunch of depositors who put their money into a bank. And why do? They do it for debit cards and for convenience and online shopping. But the bank now holds a bunch of other people's money and needs some of their own to pay employees and keep lights on and such. So the bank takes your money, or for sake of today's conversation, thanks to the fractional reserve system, they take some of the made up money and they loan it out. Now, a lot of people don't like to talk about it because it sounds weird, but this is how it actually works, and usually it works really well for the banks. But there are a significant amount of situations where it does not work really well for banks, and this is what happened with Silicon Valley Bank. So one of the biggest problems is that this bank decided it wanted to work with a very specific type of company, which were startup businesses. And generally speaking, this is not very good when it comes to any business, especially a bank. You generally want to have a wider variety of the type of businesses that you work with, which will become apparent as I keep diving into the situation. So now let's set the scene. During the pandemic, there was a bunch of run-up in investments and startups, and there was a bunch of companies that were raising a lot of money. That's venture capital or venture raises, if you've heard of that. And so what happens with these companies is that the money comes in and you keep it, but then you slowly burn it off while you're building your company. So for instance, you might raise $1 million, but then you spend $200,000 a year for 5 years. Meanwhile, you've put that $1 million into a bank, Silicon Valley Bank to be exact. Now, just like before, SVP now has $1 million of your money, but they don't have any of their own money to pay bills and employees and such. And thanks to the fractional reserve rules, they can now loan out $9 million. And the bank has to do something with that money in order to make some of their own. So one of the things that they did is they bought a bunch of mortgage-backed securities. Generally speaking, these are very valuable assets. And I know some of you on this video might be shaking a little bit as you realize that yeah, mortgage-backed securities were that thing back from 2008, but they've been regulated now, and they're a little bit safer. And originally, when they bought them, they actually had a better rate of return than the government did. Well, again, the central bank of the U.S., the Fed, which had a 0% rate of return when these mortgage-backed securities were purchased. So the idea that the bank had here was that if they needed to sell them, they could, and it wouldn't really be much of a big deal. But here's what happened. The government actually raised interest rates. So the actual central bank of the U.S., the Fed, the interest rate there is now higher than the rate on the mortgage-backed securities that Silicon Valley Bank owned. So what that means is that makes it way harder to sell them and way harder to turn these into actual dollars. At the same time, there's a bunch less money coming into the startup ecosystem, and the companies that SVP already had, they're not getting the same level of deposits that they used to, and they're burning through their capital at their normal rate, and there's not a bunch of new stuff coming in because people aren't really investing in the venture capital space the way that they used to. So let's do some math here really quickly. If you're the bank, you've got less deposits overall. The deposits that we did have are being used. The mortgage-backed securities that we bought to make money aren't making us any money. And our fractional reserve banking system is coming down a lot because of our deposits that are being used. And again, this is primarily happening during a pandemic. So what does SVB do? To make sure they can cover the liabilities, they start to sell some of those mortgage-backed securities at a loss because the rates just aren't as good as the government rates. And just to be extra safe, they do a venture capital raise. So here's the problem. The second that they announce a capital raise, that freaks everybody out. Think about it. If this was you, you've got a bunch of money in your favorite bank, and then all of a sudden you hear that your favorite bank is now raising capital, raising money, and maybe you heard that they were selling their securities at a loss, right? Most people who are banking with SVP are now in panic, right? They're going, oh my goodness, they're raising capital, they're selling these securities at a loss. Maybe there's going to be a run on the bank. What that means is everyone goes to the bank and tries to take their money out at the same time. And maybe the bank won't have enough money to cover the withdrawals, and actually that's exactly what happened. As soon as the bank doesn't have enough money to cover the withdrawals, the bank is insolvent and has to be taken over by regulators. The worst part, in my opinion, is that the majority of customers at SVP were startups that had venture raised, meaning they had way more than $250,000 in the bank, which is what is insured by the FDIC. It's super sad. If you watch more of our videos on this channel, you'll actually realize and learn that's why privatized banking is absolutely the way to go. No worries about runs on the bank. No worries about contribution limits and what's insured or not. And most importantly, you'll learn how to make your own loans and earn money just like most banks do. So anyway, thanks for watching, and we'll see you next time.